Is the UK property market about to crash? Well, we're just about to have a probably 13th interest rate increase by the Bank of England in a row. And this is something that hasn't happened before. If you look at a graph, it's like a spike, the way that interest rates are going up. Why are they doing that? They're doing that because they're really trying to curb inflation, which is the cost of living, which is increasing really quickly. They're trying to control that. Think about it this way. It's a kind of tax. It isn't a tax, but think about it in a way like it's a tax. What the government is doing is putting less money in your pocket by removing some of that money from you, so you can't spend as much money, which would effectively slow the economy down, and that would bring down inflation. That's what they're trying to do. And the way they do that is by increasing interest rates. That means your mortgage will probably go up. And if you're renting, that means your landlord's mortgage will go up. They'll probably want to increase your rent. So effectively, everybody's hurting. And that's what is happening in the marketplace. Now, what that also does, it slows down the appetite for people wanting to buy property. So if we roll the clock back to, say, last year, summer last year, the market was booming. It was on fire. A property would go up for sale. There'll be several people fighting over it, trying to buy that property. And most probably, the sale price agreed will be higher than the asking price. But that isn't the case right now. It's very different right now. A property goes up for sale. There might be a few people interested. It might be stuck on the market for some time. It may even be that they drop the price after a little while and there hasn't been much interest. The reason for that is because there's still plenty of stock on the market available for sale, but the number of buyers has decreased for a couple of reasons. One, the number of buyers have decreased because people are no longer thinking about moving home as a priority because their costs have been stretched. They know they're not getting the best deal. And also when they go to the bank to try and borrow money, the amount that they can afford to repay each month, what that gets them in terms of level of debt, is less than it was this time last year, because the cost of that debt is now significantly higher. And that is absolutely key. So what that means is, let's say somebody could borrow £200,000 last year in order to be able to buy a property. Maybe they're buying something for 250,000. They borrow 200,000 from the bank. They put in a £50,000 deposit. Now they might still have a £50,000 deposit, but because the cost of living is higher and the cost of paying and servicing that £200,000 mortgage is much higher, they won't be able to borrow 200,000. They'll borrow significantly less, which means they can now no longer afford the same property they could have last year. Then, of course, there's landlords in the marketplace and investors. They're the other people that buy property, and purchasing property via bank finance and debt is now also more expensive for them. So they're being a bit more cautious because the return isn't there. That's been really squeezed for them. So when we take these things into consideration, what's happening when you look at basic economic supply and demand? The supply has pretty much remained the same, hasn't really moved very much. There's still property come to the market, but the demand has started to drop off. So what that means is then prices will also then start to fall. Now, are they going to fall in such a way that the market spirals out of control and the market collapses, prices collapse and they get slashed? I think that's very unlikely. It's unlikely because there's still actually a lot of money around. There's still a lot of liquidity in the marketplace. You can still borrow money. But when we compare this to, say, 2008, when the market crashed, then there was a lack of liquidity. Money wasn't easily available. You couldn't borrow money from the bank to buy. Prices had fallen. People had an appetite to buy. They wanted to buy, but they couldn't borrow the money. Right now, there's still money available. People have money. There's money that you can borrow from the bank. It's just that the money is more expensive. So it's not that you can't access it. So that's also pulling prices down a little bit, but it won't allow a crash to happen because of that money is still there and people are still eager to buy. The numbers just need to stack. So as I mentioned earlier, interest rates are rising and they'll probably continue to rise a little bit further yet because they haven't really taken the real impact that the government want the general public to feel, i.e. the public are not in enough pain yet. Many people are managing with the cost of living, or their rents have gone up to a point they can still afford them. The mortgages are stretching them, or for some people they're on fixed mortgages, so their mortgages haven't yet increased until they come off that fixed period. So the pain hasn't really been inflicted on the public. But when that starts to take effect, which will probably, it could be another 6 months, it could be a year before that really starts to happen, that's when you'll start seeing a further slowdown in the marketplace, and sellers will start to be more flexible because, again, the level of interest and the buyers will start to drop off. When I say interest in people wanting to buy property. So these factors are slowing the market down, but they're preventing a crash because there's still plenty of money out there. People still want to buy. We also have to take into consideration that the property sector is a major contributor to the overall economy, and the government doesn't want the property market to collapse. It doesn't want the yo-yo effect because it's not healthy for the economy. So they rather slow it down and allow it to collapse. And the government influenced the market massively. Things like stamp duty, mortgage guarantees. There's lots of things that the government can do to influence the property market, either to drive up demand or to slow it down. So they can control and pull those levers. Sometimes they pull them a little bit late, which is what happened last year, where the property prices just spiked. And by the time they catch up, there's already been a little bit of a boom. So that's something we need to be mindful of. But personally, I don't think the government's going to allow that to happen. And none of us have a crystal ball. None of us know for sure. We can only base it on our experience, our understanding of the markets, what's happened before, and what we can see around us that's happening right now. So I think it's very likely market will decrease. So the key learning here is the time to buy property is right now. The opportunities are already out there. They'll continue to be out there for the next year, 2 years. Then the market will probably move and it'll change. It'll probably start increasing again. At that point, you'll look back and you'll think, I missed out because that was the time I should have bought.